This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. In this, our 500th episode, we welcome back Christian Kameir, managing partner at Sustany Capital. Sustany Capital is a venture capital firm investing in blockchain and decentralized finance solutions. In this in-depth interview, Christian speaks about central bank digital currencies and answers many questions to include the stated objectives, different concepts that are being discussed around its development, business sectors most likely to be influenced, who stands to benefit the most, and CBDCs versus physical cash, and much more. Christian, thank you for joining us again.
Thank you for having me.
Great. So as investors with a focus on financial technologies, how are you thinking about the history of money?
So presentations on the topic of money, and I'm sure you have seen a lot of those over the years, they will frequently start with a timeline that correlates to the emergence of bartering commodities for grain and salt. And that is typically dated some 11,000 years ago. And another data point there is typically the minting of currencies, which happened around 600 years before Christ. But as far as I'm concerned, the introduction of double entry bookkeeping is probably the most important point that we should focus on, which was at the end of the 13th century, because it has a longer lasting impact. But then also, if you look at this from a legal perspective, all of these accounts, if you will, of ledger entries, they are stipulating debts, right, which may vary from time to time. So you're updating your accounting entry. This is a technology that initially was kind of correlated with recording these things with pen and paper. However, I mean, even during the time of the Medici, which kind of popularized double entry accounting, literacy was maybe 50% at best. So it's likely that many of their counterparties would have just simply memorized the obligation. So my point here is that this kind of what I call a wetware ledger, like the human brain, the wetware, it seems likely that this was actually the case even much longer before humans started to even settle down, right, 10,000 years ago. So in that sense, if you think about it from a human history perspective, we've been around for some 200,000 years. For the most part, we used wetware as accounting. Right? We would just memorize that we had a debt to another person, and that debt could be that of, I have to fetch firewood, or I have to bring you some kill, which is actually pretty extensively explained in David Graeber's book, that the first 5,000 years of a lot of people that haven't read it should read it, I think. So rather than putting much emphasis on seashells and these ray stones that you typically see in presentations or even paper money, I think of the evolution of money mostly in terms of ledger technologies. So starting with your memory, evolving to carvings and wood and stones to paper, before then eventually most of it became digital.
So how does your firm structure the due diligence for money technologies? How do you handle that?
Yeah, our approach to investment and due diligence is rooted in first principles and the scientific method, right? As such, we spent the last 3 years developing a lot of detailed theories about the impact of technologies on various sectors of finance, which we usually share for peer review. So our starting point, if you follow the scientific method, is simply the documentation of the current state of money technology, which I like to divide in 4 basic stages. So the creation of money, the storage, the movement, and then also to some extent, the elimination of monetary value. So within these 4 stages, then you can observe the friction that legacy systems introduce. So most often this friction will manifest in time delays, fees, and some procedural hurdles such as KYC. Right? So the sum of which can then be understood as the total addressable market. Right? And so during due diligence, we evaluate the capacity of the technology to reduce this friction and then capture market share within our investment horizon, which is usually 5 to 10 years. So we collect all the available key performance indicators, like what most people will have heard of, customer acquisition cost, lifetime value, net promoter score, etc. And experienced teams will have researched these values, and they will have created their own theory on the addressable market and how to capture that. So in that sense, our due diligence process resembles mostly that of kind of a peer review, because we come with our own thesis that we then either get challenged or that teams will actually, to some extent, adapt. So by now, we collected some several hundred peer reviews on all of those different topics over the last 3-4 years.
Right. So let's talk about central bank digital currencies. What are the stated objectives for CBDCs?
Yeah, so there are quite a few and quite diverse, but I think it best boils down to about 5 points. So universally, all authors will take the position that CBDCs must promote financial inclusion. Right? Worldwide, there's 1.7 billion people that are still unbanked, and even in the United States today, 7 million households, so probably 14 million people, but according to just the recent FDIC survey, unbanked, and then a much larger portion is actually underbanked. Right? The second point that most of these papers will make is to improve cross-border payment. The third is probably the point of programmable money. And the last point is often combined with the ability to facilitate machine-to-machine payments, IoT payments, and often micropayments. And something that payment solutions today largely cannot support because of the fees that are involved with even small transactions where like the minimum is 25 cents and or percent. And then most papers further point to the ability for CBDCs to instantly settle. So most consumers today already perceive that payments instantly, but from a merchant's perspective, these payments typically don't settle in a matter of hours. It's typically days and sometimes weeks. And so the last 2 points, I think, can be best summarized under the label of competitiveness, because CBDC developments are currently undertaken by about 80% of all nations on the planet in various stages. Some are, like China, piloting already. And so if you want to be competitive internationally, I think you need to develop a CBDC that provides the programmability and the instant settlement component as a minimum.
Right. So what are the different concepts that are being discussed around the development of CBDCs?
Yeah, so the primary differences are in the topic of what's called wholesale CBDC. So they would replace or probably complement reserves at central banks that commercial banks keep there to kind of a restricted access token. And this token, you can think of it as a digital bearer asset, right? So this would then settle immediately. Right now, I think the fastest window is something like 4 hours, but typically it's much slower. Right? And even with larger payments, you probably have heard anecdotes where banks themselves have to send themselves checks amongst each other for million or billion-dollar payments, because that's still the fastest way, which is kind of absurd in today's day and age, right? The second concept, though, is that of retail CBDCs, or sometimes referred to as general purpose CBDCs. So this is the type of currency that then would be available to consumers and would be described as a legal tender, obviously, which would combine but for all intents and purposes, the facilities that cash has, but also account-based systems.
And so what classifications do you apply to CBDCs and money technologies?
Yeah, so as technology money's utility increases and decreases with network effects, right? The more users accept it in exchange for goods and services, the greater the value of the network. So for example, 90% of all money in the United States only exists as ledger entries. And that's true for most money in the world. So moving it usually involves the manipulation of numbers that are stored in databases. So from a technical perspective, euros, yen, and all cryptocurrencies are simply bytes. And so the unit of account only matters for the visualization, so for the better understanding of the user. Right? That's not part of the technology, it's part of the user interface. So that's why if you have a cryptocurrency, you will usually see that your Bitcoin value, your Ether value, your XRP value, or something else is typically translated, right? You always see the value shown also as the dollar amount it represents, or if you're in Europe, you see the euro amount it represents. So in that sense, we can today state that the default medium of exchange for 97% of all transactions has been bytes for quite some time, while the primary function of money is simply that of unit of account, or simply that of the language of value of the user. So as technology investors, we'll take a very, very nuanced view on the topic of money as a technology specifically. So if you observe that a lot of people in the banking industry in presentation, they typically tend to use this old textbook definition of Gibbons from, I think, 1875, which says that money is a unit of account, a store of value, and a medium of exchange. And that really doesn't hold true for the technology that we're using today, right? And it's mostly about if and how good bytes that we're storing are moving and are representing the user's interest. So speaking in broad money term, that's primary right now as of today. Let me see. Can I share that slide with you? I think that's kind of an interesting slide. If you just look at broad money terms, do you see my screen, by the way?
Yes.
If you look at broad money, right? So cash, and actually, that's an up-to-date number. So cash is quote unquote only 1.8 trillion right now, right? So, but there's almost 4 trillion at the moment in checking accounts. You got a lot of corporate debt, you got mortgages, and the largest groups right now is certificate of deposits and money market accounts. CDs are the larger part. And then you got other groups you factor into broad money, that's student loans, auto loans, C-loans. So the larger point here being is that, so these bytes are all storing value. The question is for who and how, right? So while users think of their CDs as savings accounts, they're indeed lending out their money, and currently mostly at rates that are below inflation rates. So with few exceptions, money stored in account-based systems is either borrowed by the account holder or lent to the account holder. In the case of checking accounts, no interest, right, that you're getting. So our classification focuses on the main use cases of money, which is simply spending and lending. Right?
So what business sectors will be most influenced by CBDCs?
Yeah, so considering that these use cases of money today can be simply put into spending and lending categories, and the former use case, as you can see, is much smaller than the legal lending part. So there's about $2 trillion a year that are being generated from payments worldwide, whereas mortgages in the US alone are currently $10 trillion. So in the United States and most other countries, as we pointed out, money only exists as database entries, and they're either liabilities of the company maintaining the ledger, usually a bank, or the client of that institution. So CBDCs, in principle, enable the user to perform self-custody. So rather than leaving their funds in checking or savings accounts, and they could further make these available to peer-to-peer or managed lending markets. And we see that very nascently already. I don't know if I put it here. I don't think I did. Okay, I did not. So we can already see this very nascently in what's called the DeFi market, the decentralized finance market, which is predominantly marked by lending cases. And right now there's only like $12 billion locked in those, which obviously is very, very tiny compared to the traditional lending markets. However, that's largely due to the fact that the onboarding of fiat currencies into the space is either cumbersome and or mostly expensive. Right? If you're already a percentage down, if you onboard your fiat into those systems, and right now that's not something that you can use. So there's no CBDCs, you have to buy crypto. Then you're already down as a starting point. So that's the largest friction that CBDCs could remove.
In what ways are existing fintech companies impacted by CBDCs?
Yeah, so if you think about this, so many fintech companies had integrated their solutions with the legacy financial service providers. So they typically create some proprietary interface, which on the surface provide a better user experience. Right? The underlying technologies, however, in some cases date back to the 1960s. You probably have heard this fairly recently. It came out during the COVID situation that there's a lot of databases that still use COBOL, and they're largely used by either the government and or financial service providers. So this technology that has been incurred by the legacy fintech systems, like I would want to call them, this extends then to the fintech companies itself. So fintech companies themselves make it exclusive for extensive use of database solutions to store mostly customer and transaction data, but it's a little bit unclear what specific technologies CBDCs will ultimately leverage, but it seems to indicate very strongly that central banks, which are already piloting blockchain-based solutions, and most CBDC discussion papers suggest that blockchains are the likely design choice, will tend towards that. So fintech companies of the past, they will have to heavily invest into new infrastructure to compete with startups in the space, which themselves can start developing these systems from a blank slate. And a lot of these building blocks here are actually open source solutions. So there's no additional cost, typically for startups that want to start leveraging these solutions, which we see specifically in the DeFi space, where there's new solutions now emerging, at least on a weekly basis, sometimes every other day.
So how can commercial banks prepare for CBDCs?
Yeah, so based on the current proposals that we've studied, a design choice for most CBDCs will be that of transferable digital bearer instruments. So this peer-to-peer requirement suggests very strongly that they're going to be similar to cryptocurrencies such as Bitcoin, right? And even Brian Brooks over at the Office of the Control of the Currency, he issued a statement not so long ago in July this year, stating that federally chartered banks already have the authority to custody cryptocurrency, which suggests to me that commercial banks should embrace that option and start hiring personnel which then can assist with building the technical requirements for those and then consequently likely for CBDCs. The problem a little bit that we've seen is that almost all of the legacy technology providers that like serve the banking space, they're offering something that is blockchain branded. However, from our perspective, doing due diligence on cutting edge technologies, most of them don't really meet the criteria for what we deem to be necessary to be competitive or even viable over the next 5-10 years. As such, I think the first step for most commercial banks should be that to seek some independent advice to understand the technology in the space. And as you know, we kind of do this on a bi-weekly basis because we're doing this anyway. So we kind of like to share this for education.
So what impact will CBDCs have on the average consumer?
Well, you can think about this in two main groups, right? One of that is kind of the global constituency, and then you've got the national perspective. So statistically, central bank currencies only lasted about 27 years before they feared, usually due to hyperinflation, right? And given what I would consider right design choices, a CBDC would make it easier for citizens to combat this type of inflation. And if you look at the past, quite often the average consumer, when their own currency started to weaken, have turned to what I would call their secondary language of value for their everyday payment needs, right? In the past, it has mostly been the printed version of the US dollar, so about 900 billion worth of US Federal Reserve notes. So that's more than half is currently held outside of the US. So they're kind of interest-free loans, if you will, from a legal perspective. And de facto, they are really never coming back. So there's some good articles that would claim that the US dollar is actually the most profitable export product of the United States. But there's good arguments to be had for that. So an efficient CBDC design, but then would enable the average consumer around the world to move only into cash for payments needs purposes. So this has largely impact on every national basis, which you could then leave funds otherwise in something that is actually interest bearing. And so this seems to be the expectation by some of the authors of the CBDC design papers, because they actually suggest themselves already that CBDCs might already be interest bearing themselves.
Well, can CBDCs help to solve the problem of unbanked consumers?
Yeah, when you talk about unbanked consumers, you can think of those in about three classes. So there's individuals who simply cannot open a bank account because they don't have some government credentials. They are undocumented, either in this country or that's actually more predominant in other countries. Then a second reason would be simply the unwillingness of banks to open bank accounts to lack of credit history. Otherwise, these people are deemed unworthy. And then lastly, and that's actually a significantly large group, some consumers simply don't trust banks. They're old enough to have seen bank runs and bank failures, and that has been true in the United States every year, with the exception of 1 year where there was no bank failure. And so people who had a bad experience simply don't trust it. So if CBDC designs are modeled after cash, they wouldn't require government credentials. And obviously, if you could hold it yourself, you could custody the digital dollar yourself. For example, you didn't have to trust the bank. So that would persuade people who lost faith in the banking system. And then all of those people could then actually receive payments directly into digital wallets.
So who stands to benefit most from CBDCs?
Yeah, so The primary focus, as far as I can tell by reading a lot of these discussion design papers, has been that of payment functions of CBDCs, which I actually don't agree much with, since, as we've seen earlier, the primary use case for fiat money is that of lending. So I think there should be more consideration given to the lending function of that. But made as it be as such, so point of sales provider and digital wallet startups that are prepared for the introduction of CBDCs will probably be able to take a lot of market shares from their competition. Albeit, I think that the important part here to consider is that if you take cash as kind of quote unquote gold standard, if you will, for payments, well, gold standard, what I mean by that is I'll give it to you, I don't have it anymore, you have it, it settles the transaction with finality, and no one had to look at your passport and so forth. So these are all qualities that make cash as a payment method really, really attractive. And that's why you see certain merchants actually putting out signs like, sorry, we don't accept credit cards, we only accept cash. And that, by the way, is a choice of every merchant, at least in the US. I don't know much how it is for most other countries, albeit I expect that's true for other countries as well. So there's a somewhat of a misconception, actually, that I have to correct quite frequently when talk about this topic, is the misconception that legal tender laws require the merchant to actually take fiat currency as payment. That's actually not true. So legal tender law only set forth that it's for payments to the government and for debts, right? So it's actually the choice of every merchant to decide, hey, I only want to be paid in Bitcoin, I only want to be paid in cash, I only want to be paid in Pokemon stock, for that matter. So the larger point here being is, once you realize that as a provider of point of sale systems or digital wallets, you can introduce much more interesting payment solutions. And from that perspective, coming back to the original cash payment that doesn't carry any fees, it doesn't carry any friction in terms of needing to do KYC and so forth. My expectation would be that payment, which the entire industry today is $2 trillion globally, will actually move to zero alpha, so to zero profit. So what that means is that this could be leveraged by startups in the space that provide the payment function using CBDCs for free, while introducing additional services, a common loyalty system or any additional analytics, and then provide something of a flat fee, rather than what you see now, where almost all payment systems that merchants have are metered, right? So they will have a one-time fee for a transaction and or percentage of the transaction amount. And that's holds true even for the largest merchants. I think the largest number I saw for the largest merchant on the planet, which is Walmart, is they still have to pay 1% credit card fee, which that is a lot of money for a company that makes billions of dollars every week, right? So that is a lot to pay in transaction fee, which in that case, Walmart specifically already had contemplated to introduce their own currency, which in my opinion, a lot of companies should intermittently do before CBDCs come around. Right? That's a much more attractive method, and stablecoin could be issued by all of these merchants almost instantly, right? At least for internal use and or payments to suppliers. So that would be my strong recommendation. So larger point, who stands to benefit most from CBDCs? I think it's initially because of the strong focus on payments and the requirement of that to be legal tender, so interchangeable for account money and central bank money. I think merchants specifically and payment providers will benefit the most. Long term, though, I think, as I mentioned earlier, it's anybody who provides some form of lending facility.
So how would you describe the state of money and CBDCs today?
Yeah, so it's very fragmented, and the communication is also very different. So you probably saw that China supposedly is very far ahead in their deployment of CBDC. They recently kind of put out this marketing message of giving away free money to merchants in Shenzhen and consumers in Shenzhen that could just spend that particular CBDC. But they actually had to spend it within a given time frame, which is also interesting. So they are supposedly piloting this, but I'm somewhat skeptical of this particular development, specifically because what I would presume the intent is somewhat different than most other CBDC designs. I'm not going to comment on kind of the political intention of the party that's supporting this particular development, but I don't put this necessarily in the same bucket. I wouldn't expect that outside of China, there's going to be much interest in adopting this specifically. So then when you look at CBDC developments in Europe, which I'm fairly familiar with, they're much further ahead in their discussions than here. And then Canada specifically, I think it was either, I want to say it was Canada who started the first research in that space. They were very far ahead, and then they kind of put on the brakes. One of the reasons and one of the hesitations that actually by, I think the Australian development team has been mentioned is their concern of what it would do to commercial bank systems. And that's rather obvious if you think about it this way, that anything that's not physical cash is basically sitting in a bank account right now. So it's sitting under the control of some commercial bank who, for the most part, will be able to monetize that. Even though most people will have heard this pesky term fractional reserve, has actually never been true. But even if you ignore that, there's a lot of money to be had and to be made simply by being custodian of funds that are sitting under your control. So this control could potentially be given back to the kind of rightful owner, to the account holder, who can then either make that interest himself and or give it to others to leverage it in this way. So the critical point here is, in my opinion, if and how the conversion between those different fund stages will be. What I mean by that is, so right now, most of the money is sitting in things like certificate of deposit, so time locked, and money market accounts. And right now, you're probably aware that the rates for CDs are well below inflation. And so that's really not a good place to park your money. It's not really storing value for you much. It's actually using value, right? So from that perspective, CBDCs could mitigate a lot against this inflation. But that's also obviously where we have strong pushback by the incumbents that will see a lot of their holdings being diminished. So long story short here, the state of these discussions is sometimes actually actively paused, and where developments just said, right now it's unclear what this would do and to commercial banking, and I think it might be very negative to commercial banking. At the same point in time, what everybody that is concerned with these topics has realized, it is a competitive necessity. It means if and when one country that is relevant in global trade will introduce its own CBDCs with the facility to do instant settlement, with the facility to create programmable money, this would be an enormous competitive advantage. And so if you look at this from a global perspective, and I don't know how to show my screen here. I think I have one where we have kind of the distribution of, world reserve. So this is kind of the world reserve status today. The US dollar by far is the world's reserve currency, with the euro being a second distance. That is our strongest export mechanism, our strongest argument. And then from a network perspective, the fact that you can pay in US dollars in a lot of other countries where they readily accept it is a very important network effect that the US dollar must maintain. So I think that other countries are realizing that and are more interested in introducing a CBDC exactly because of that, because it could actually take away to some degree the majority of international trade financing.
So how do you evaluate the competitive landscape of money technologies and CBDCs?
Yeah, so over the past, I want to say it's already been 5 years at this point in time. So we have obviously seen things like quote unquote stable coins emerge. And I used to call these intellectual time travel. And that's specifically because usually when you read the white papers, and I think maybe by now they kind of realized this themselves, they introduced stable coins as kind of fixing the error that Bitcoin introduced. And by error, they were typically referring to the fact that Bitcoin is very volatile, right? And but trying to mitigate against the volatility. But then if you simply analyze what happened with the usage of this instrument of stablecoin, so let's use the largest one by market cap, which is Tether, and was the earliest one. So we'll realize that the actual use case is simply that of trading, and it's typically trading on custodial centralized exchanges and typically as an exchange mechanism of Bitcoin. So the point here being is it had nothing to do with using it for payment, right? Which was the main argument that was made by these white papers initially. And simply, in my opinion, what that's ignoring is that the main friction point is not the volatility. The main friction point is the fact that I, as a user, don't understand the value. It's simply my language of value is something else. I want to understand it in terms of dollar. I want to understand it in terms of euros. And from a technology perspective and from a technology investor's perspective, the worst thing you can do is introduce a new technology and introduce a new language with this. This is probably the largest friction you could introduce and the biggest point to prevent adoption. And we still see this today. And we've seen dozens of stablecoin projects, and they all have the same problem. Another problem, and that's partially being mitigated against this, even if you use a quote-unquote stablecoin, none of those are actually stable. So none of them ever held the peg one-to-one for any length of time, even though for most of them, the differences weren't all that great. It might be a penny, it's in some cases for a day was something larger than that. But even if it's just a penny, it's still not stable, and it's still introducing this mental friction, which again, that is the larger point that prevents those instruments from adoption. But then the obvious one in terms of payments is there's still no payment system that is willing to adopt it. And then the largest one, I think that's often forgotten, and that I think that's kind of been pushed by the side with PayPal's recent announcement is, for the most part, the exchange of even a stable coin or any other cryptocurrency for that matter is a taxable event. So imagine this, you're paying for your coffee in a Bitcoin or a stable coin, and it becomes a taxable event. And at the time you're filing taxes, you all of a sudden realize, oh, now I somehow have to create a line item in my tax return that speaks to the Starbucks coffee I bought on April 13th for $4.50. And I have to establish the base of how I bought this particular coin I spent this particular day. Unfortunately, again, this is mostly not mentioned. And I think it's going to be a rude awakening for a lot of people come tax times, like how to mitigate this, because all of a sudden you end up spending an hour of your life or an hour on your tax accountant to figure out what these 500 micro purchases that you did that used stable coins or cryptocurrencies in general meant for your tax return. So that is not good, right? So anyway, needless to say, CBDCs would sidestep that, and at this point in time, probably make most of these stable coins useless and superfluous.
So how would you describe the influence of blockchains on money and CBDCs?
Yeah, so largely blockchains is still very much understood. So for the past couple of months now, I've been trying to simplify it because I've been explaining blockchains to people in our local meetups for 5 years on a monthly basis. And it's still too complicated. And partially it's because, as you know, I like to say, reality doesn't have an advertising budget. So a lot of people that use that term use it as marketing term for a solution that really has nothing to do with blockchains. So in the most simple terms, what I like to say is blockchain replaces databases. A lot of times people will explain blockchain as a type of database. I think that is got awfully wrong. And here's how I like to describe this in, let's call it technology history. Remember, we were talking about the early ledgers being wetware, being your brain memorizing a debt, right? This was then followed by, let's call it sticks that were carved into as a new ledger. And then eventually we invented paper and pen, and we started recording debts in this form. And by the way, this was always the largest form of money, right? At any given point in time, paper money, so the money that Javon's described, and which was commodity money, wasn't very relevant in day-to-day commerce. So But back to how you fit in blockchain. So if you come from wetware to sticks to paper money, then eventually what we introduced in 1960 with COBOL was databases. And so then quickly banks and financial institutions and anybody else dealing with accounting entries started to use databases. But then what happened is we came about network technologies. And initially those were private networks, and then eventually the internet came about. And so we connected, and by we, I mean financial service providers and others connected these databases to networks. And this has been overall very convenient, but it overall has also been a security disaster. And so any data, basically, you can make this blank statement that sits in a database at some time was compromised. There's a lot of instances that we've heard about, and then there's probably many more instances that we haven't heard about. Right? To where everybody at some point in time, probably in the United States, has heard of and or impacted by the Equifax hack. And most people have heard that AT&T got hacked, Yahoo got hacked. So the larger point here being is databases are insecure, will be insecure, were insecure, and are not the right instrument if and when, which we have now, we have better technology. So blockchains in that sense actually replace databases. And there, the primary way of that I like to think about this is in cryptographic primitives. And that sounds like a big word, but think about it in simple metaphors. If you have paper money, right, you have it under your control. You can put it on your mattress. If you want to steal it from you, I have to break into your house. And if you're there, I have to hold you at gunpoint and take that paper money away from you. If I knew somehow in the first place that you kept a lot of paper money around, right? So that's a fairly good security mechanism if you compare it to bank accounts, which at any given point in time, databases are being hacked, and either it's for funds and or for personal identifiable data that's then being used to somehow get access to other funds. So if you forward this also then to personal identifiable data, which is actually the more critical part, think about it in terms of your passport. So the metaphor that I like to use is you take your passport out of your drawer at home, you go to a border, you hand it over to the passport agent, and he hands it back to you. So if I want to steal your identity by stealing your passport, I have to find you, I have to find your house, I have to find the passport in your house, and then I have to steal it, and then I have to somehow use it in some particular fashion. So to summarize this very simply, this is how you should think about blockchain-based solutions. Think about these in terms of digital bearer instruments, but not only digital bearer instruments that pertain to assets, such as simple ones that are just quote unquote money, but also think about digital bearer instruments that are things that are PID, personal identifiable data. So in summary, all database systems, in my expectation, over the next decades, will be replaced by decentralized software. And I use that term decentralized software because it describes both blockchains as well as DAX, which is a different instrument, is distributed acyclic graphs, which is probably the more likely technology to store PIDs, personal identifiable data. So now I think I forgot your original question. Was it competitive landscape?
We were...
No. You asked about the influence of blockchains on money. Right. So the influence of blockchain of money is, in my opinion, threefold. And that's, I think, the biggest kind of structural misconception or structural missing point from a lot of these papers as a technology. We look at this very much in three different stacks or three different buckets, if you will. So the one part is the CBDC, is the currency, is the coin, is the token, which is an instrument on and of itself. So that instrument on and of itself isn't very useful if and until you, the user, have client software that operates with that, right? So let's call it your digital wallet. So the digital wallet, it's its own stack, and in my personal opinion, should be developed by many, many private entities around the world. And CBDC designs should limit themselves to provide APIs that let those wallets interact with that. But then another stack that needs to be still completed, which a lot of people are working on right now, is the whole identity stack. Because if you still, as the digital wallet, holder have to then do KYC because the CBDC is being distributed by a commercial bank, let's say, and they have know your customer requirements, then you cannot fulfill the original mandate of those CBDCs, which is to onboard a lot of people that are unbanked today, because a lot of these people that are unbanked today, they're unbanked because they don't have government issued credentials. So I think it's very important to think about the design in these three different steps. And as investors, we focus on all of those three different stacks, and we have been focusing on the identity part and the wallet part much longer than we have focused on kind of the coinage part, because that part isn't all that interesting as far as I'm concerned, because that comes down to the ledger. Think about it in terms of once you have a digital wallet, and ideally your digital wallet should be able to hold a whole bunch of quote unquote digital assets. It's really somewhat of a conflated term, but the point there being is you should be able at someday in the future to hold government issued fiat, right, currencies, as well as things like the title to your car, as well as things like government issued credentials. So they should be all managed by one particular instrument. This is under your complete control. And it looks like we're coming up on the hour in 10 minutes.
Cool. So is Bitcoin a competitor to CBDCs?
The short answer is no.
Oh.
And so still today, a lot of people talk about Bitcoins in terms of money. But as I explained earlier, the real remaining function of money, generally speaking, is simply that of unit of account or simply that of language. And I've been doing this presentation on the state of blockchains a long time. And it always has one slide in there that shows a banana with a Bitcoin price on there. So I don't think that many people expect to see a Bitcoin price on a banana, right, anytime soon, if ever. So I like to think of Bitcoin as money of last resort, as in if all fiat currency fail, Bitcoin will become money. That would be the only reason. And so in that terms, it would have to replace what's currently money of last resort, which is the US dollar, right? In the past, when, I think I mentioned that before, when a local currency failed, people would usually turn to the US dollar in printed form and try to get their hand on that for the use of payment.
Well, so which new uses will the new money technologies and CBDCs create and support?
Yeah, so I mean, the obvious ones that we talked about, which is let's call it the decentralized lending space, with lending being the largest use case for money today. And then new use cases such as micropayments specifically, or we like to use the term streaming money. We actually started a book project on that term some time ago. And it will take a few more months to complete that. But think about things such as self-driving cars, where at any given point in time, you want to pay people for the usage or get compensated for the usage of that self-driving cars mile by mile, and metered in this way, where you can make micropayments that are less than a penny. You could facilitate that. And already, and that's kind of one of my favorite use cases, is right now, most payroll systems will either happen bi-weekly or even monthly. And that this just facilitates an entire industry that, in my opinion, shouldn't exist, which is the whole payday loan industry. So programmable CBDCs will make it much, much easier for employees to be paid daily or even hourly, or if need be for much smaller increments if that's valid, but without fees that are currently incurred for payment systems at large. And then the last one is anything that has to do with quote unquote IoT, the Internet of Things, where actually devices need to be able to hold their own funds to do certain transactions. And we already see some nascent markets for that, where software can pay software for usage. If I just need to use another software for a very short period of time, and rather than involving the user or creator of the software, you can assign a wallet to that particular software and say, okay, if you need additional computing resources, why don't you commission it yourself, here's some funds, and the other party will usually accept legal tender. Rather than what's happening now is I always have to figure out what the other software, what cryptocurrency it might accept, and then I have to buy that cryptocurrency, and sometimes at great expense just for that particular transaction. So that's the current state right now. So CBDCs would swiftly remove all of that. Again, given the right design choices, that is still very questionable, right? There's a lot of work to be done. Many people that I talk to in that space expect significant progress inside of 5 years. I think what we will see is that one country will make significant strides, which will then force the other countries to catch up. And or we also facilitate some more localized developments where we talk to the state of California specifically of them creating a specific payment option that is very, very relatable and would facilitate things like government payments. Think about like food stamps, etc., that are basically money to be issued on a blockchain-based solution. So the step from that to something that is a more general payment function, more general money, is much, much lower and much more prescient at this particular day, at this particular time.
Great. So what lessons do you draw from having analyzed the cryptocurrencies in general and stablecoins in particular?
Yeah, so I think the most important thing to realize is that you got very different use cases and you want to develop specific to that use cases. You want to develop your CBDC and or your stablecoin for that particular use case, and then realize that, yes, it's only going to be used for this use case and nothing else. And if and when a CBDC comes, I want to replace that stablecoin with a CBDC. So I mentioned that earlier use case of trading of cryptocurrencies on centralized exchanges. Mostly the other part where stablecoins are being used right now is in the decentralized finance space, and they're specifically decentralized lending. But I think that's the important part to realize, that the functions of money are not the ones that you might have learned in business. It's typically not a relevant store of value, and it's definitely not the medium of exchange, because if you think about this, the medium of exchange for Bitcoin is the same typically as the US dollar. It's just simply a buy it. And that is I think is largely ignored. So, and also if you think about the fact that I always have to price or label any of my stablecoin or cryptocurrency still with a US dollar label, then you also should realize that's just friction. So just make the assumption that people won't learn a new language, and make the assumption that the default medium of exchange for anything at this point in time is just bytes, and build your technology accordingly, use case specific. So don't try to introduce a new language, and don't try to sell people on something that is not a new medium of exchange, but is simply using existing rails, which is the internet protocol for most cases.
So what are single points of failure in the design of money technologies in general and CBDCs in particular?
Yeah, so I touched on that earlier. I think several points of failure is whenever you create something that's not compatible with either the existing payment systems and or new and upcoming technologies, right? And we have an infrastructure for payments that people are using. So payments, actually, in my opinion, is not the larger problem to be solved. I mean, you and I have many ways to pay today, right? You can use a debit card, you can use ACH, you can use a credit card, you can do wire transfers, you can use PayPal, and there seems to be an unlimited number of choices already for payments, right? I think that the focus here should be given more to where's the actual friction today. It's like, where are the inefficiencies and where should be facilitating payments at a faster pace? So that's on the merchant side, right? Why do merchants have to wait oftentimes up to 90 days for funds to settle? Because the settlement risk is priced into every payment that you're doing today. So even as a consumer, you're obviously paying for it, right? If the merchant to pay credit card fees, debit card fees, ACH fees, he has to price this into the goods and services that we're acquiring from them. And so this kind of extractive mechanism, I like to explain with real simple metaphor. You and I are using right now the voice over IP protocol, right? And it's entirely free. And it's been around for some time. It works really well. And if we couldn't use that, we're probably paying a metered rate to some telecommunications company. Right? And the other more obvious example to most, I think, is that of email. I mean, before the emergence of something like SMTP, the simple message transfer protocol, or POP for email, we were using mail, right? We were using physical mail. We printed a letter and then we put a stamp on that and carried it to the post office. So at some point in time, we did these thought and actual mathematical experiments to figure out, okay, if we had to put a stamp on every email, how much would this cost to us and how much would it cost us as a society? So take a wild guess how fast it would exceed the gross domestic product of the United States if every email needed a stamp that's being sent in the United States.
A month?
It would take a day and a half.
Oh, wow.
So, but in a way, we now have the technology to actually do away with all the fees for transferring money as a starting point and then transferring value in general for free. And we need to catch up to what the technology can be doing and what we're actually doing in our day-to-day terms. I mean, banking is an enormous industry, and I'm not saying that banking should or will go away. I'm just saying that it should embrace technology much, much faster than it has. Right? So that is the largest problem. It has been a huge drain on the economy, if you think about it, because for the most part, these are non-productive activities, if you think about it, because they are part of the transaction, but they're not necessarily adding the amount of value to the transaction than they're expecting, to put it mildly.
So what are the most common misconceptions you have observed on the topic of money in general and CBDCs in particular?
Yeah, so I touched on that several times because it's such a big pet peeve of mine. So the biggest misconception is that not everybody, but a lot of people, and you will find this if you read some of the CBDC design papers, will cite the functions of money as unit of account, store of value, and medium of exchange. And this dates back to 1875, and that was created in a textbook by a British economist called Jevons. And during the time, or actually the year after Jevons published that, Alexander Graham Bell got the patent for the first phone. And that's why, let me see if I can bring this up real quick. If you look at the first phone, right? So this is Jevons' definitions. I don't know if you see my screen, let me know. This is a phone that was created by Alexander Graham Bell the year after Jevons published that. I don't know if your phone still looks like that. Mine doesn't.
Mine doesn't either.
The point here being that, so Jevons is describing a technology of his time. He's describing basically the facilities of commodity money. So this is like describing the phone today in terms of how a phone looked like in 1876. And that is kind of my biggest pet peeve. It's the biggest misunderstanding around money in general. So money today has nothing to do with money of 1875. It's not commodity money. And the commodity money was actually never a relevant medium of exchange, even in Jevons' time. Right. And so that's probably the most common misconception. The other misconception and the common mistake we're seeing is the conflation of functions. So that has to do with the particular definition that we're citing. It also has to do with any other cryptocurrency and any other stable coin that wants to introduce a new unit of account. It's not going to happen. You won't be seeing a Bitcoin price on a banana. You won't be seeing a DAI price. You won't be seeing a Tether price on a banana. I will take any number of bets against this happening anytime in the future within the next 10 years. It's simply not going to happen. So those are the two main misconceptions. Then another misconception that we haven't touched on, but I think it's very related and should be understood much better, is the concept of inflation. There's oftentimes, and I made this mistake myself, I have to admit, some time ago, where I would show a slide that would show the decline of the US dollar in terms of its comparison to the value of dollar, right? So in terms of the value of gold specifically. So the typical inflection point that's being used is the quote unquote Nixon shock, when Nixon finally took us quote unquote off the gold standard in August 1971. And so, as I mentioned, I've shown this slide myself, and I will show you that for the past 30 years, the dollar has lost 97% of its value because of the amount of gold you could buy at the time when it was still on the gold standard, which is no longer the case today. What this ignores entirely that is even back then, most money was actually still held in accounts. So today it's 97% of money is held in accounts. Even back then it was 92% of all money was commercial bank money. So this is referring to the common misconception that the main money creation is done by Federal Reserve banking. The main money creation is being done by commercial banking. And so this is inflationary if and when it's being done for unproductive means, i.e. if you create yet another new mortgage for a house that already exists. So that has been the biggest point of inflation. And so by some math, and it's mostly driven by researchers out of the United Kingdom, this has inflated the asset primarily on average by more than 10% year over year, but then also obviously has added to overall money supply in that same amount year over year. And so other creation of money has been done specifically to inflate things like education, so specifically student loans, because it's very attractive for banks to create this form of money since the loan holder cannot default on the debt. So the larger point here being is a common misconception is that inflation is being caused by the Federal Reserve banks creating money. No, inflation is caused if you create new money for non-productive means. And it's primarily caused for on and for those assets. And the secondary part is then on the overall money supply and your usage of money as a form of payment, which if you understand this, then I think the overall mandate for CBDCs in general, and I think we touched on that earlier, is to allow people to step away from that inflation, both on an international level, but then also on a national level. Think about it in terms of any money that's sitting in your account right now is being used for lending purposes, right? So it's being typically lent out by your bank. Either it's being lent to you or it's being lent to us. And this financial institution gets to make interest on that. So that same option right now, because you can't custody digital assets, is not available to you. So if and when it's available to you at the most efficient rate, i.e. means if you could swap out of your certificate of deposit into your checking account, right? Instantly, there wouldn't be a need for you to keep money in your checking account, in your demand account at any given point in time, if and until you want to use it for payment. So my expectation is that either a CBDC and or cryptocurrencies, and probably more likely both, will enable this facility. So what this will do as an extension, it will go a long way to mitigate inflation, right? Because it would allow people to sidestep this inflationary behavior of currencies in general. And ideally, it would enable this on an international level. But again, that is obviously at this point in time mostly speculation, but I would love to see this implemented in design choices. Does it make sense?
Yes. So will privately issued money compete with CBDCs?
It could. It could if it's better money. You probably have heard of the term Gresham's law, which is a little bit funny that it's Gresham's law because it's a simple fact that bad money drives good money out of circulation. That's the long version of that. And this is actually already mentioned, I think, by Aristotle before Christ, but eventually got attributed to Gresham much, much later. So the point here being is that most money right now, as we established, 97% and probably much more, is actually a representation of something else, right? So if it's a mortgage, it's a representation of something that's owed on a house, so it's secured by the house. So the larger point here is that good money is ideally secured, right? It's secured by something that I can ideally immediately liquidate. And we see this right now in the decentralized finance markets, to where there is very, very little risk to pledge your digital asset. The reason being is because it's pledged in a way that's locked into a smart contract. And if it's being lent out, it's actually secured in a way that if you lend it out and the borrower doesn't follow its obligations, it's simply being returned to you immediately through a smart contract as an automatic function. So if you have private currencies that is backed in a very similar fashion, but eventually by a physical instrument, and we see the nascent implementation of those things, think about securities that are based on the securitization of physical assets such as houses. So you can imagine that if that lending system is large enough and it's about to issue its own cryptographic currencies that is US dollar denominated, but it's secured by a house rather than by the promise of a government, that might be very attractive to a large portion of the population, not only in this country, but also obviously in other countries around the world. So in this particular case, and A, if it's branded with something that's known, like the US dollar, and then B, if it's branded by a known entity, like a large commercial company that is already trusted for what it's been doing, and this could be a bank or that could be a mortgage service provider, then this might have much greater attractiveness than a CBDC.
So what is your thesis on the impact of CBDC on the foreign exchange markets?
Yeah, so there's some expectation that essentially Forex will be extended to users in general, to the general population, because right now you probably know this, that there's very little alpha in the foreign exchange market. It will take tens of millions of dollars to make any significant amounts moving this money around. And there are only about 10 large banks that are really involved at scale in doing Forex specifically. But if and when this becomes available to the average user, so if there was interchangeability between CBDCs of different countries, so then you can envision that you have a smart wallet where you can set a function to say, well, if my local currency is more inflationary than another international currency that is swappable at any given point in time, well, then I can check a box and decide, okay, instead of holding my local currency, let's say it's the Bolivar, or let's say it's the Naira or something like that, at any given point in time, just hold it in my wallet as US dollar or hold it as US dollar. So if and when this happens, and it's not likely going to happen soon, but it will eventually happen. And my personal expectation is it might happen by accident. Right? It might happen by someone creating an instrument that just happens to be pegged to the US dollar, that's issued and guaranteed by a government, and it starts to spread in some beachhead like a small island nation, and will then find enthusiasts around the world that realize, oh, this is always being backed by the US dollar in essence. It just has this other funny symbol, but if I want to spend $1, I can just swap it, which is the facility. Then this will all of a sudden become very attractive to potentially a big group of users. I mean, the most imminent threat that, as you probably know, has been identified Congress are things that are social networks, in their particular Facebook and their offshoot of Libra or whatever they're calling their digital currency right now. Because again, it comes down to what I said in the beginning, money lives off the network effect. The important lesson here is that money itself doesn't have any value. That's why it's so misguided to think of this as a store of value. That the main value, quote unquote, in money is in the technology, and there specifically its network function. Like, so how many people are accepting it for payment? How many people are accepting it today, and how many people do I expect will still accept this tomorrow? So if you then combine this with a large user group, like 10 billion daily active users on a social network that then all of a sudden can trade with each other, that is very potentially dangerous to a nation's currency. And obviously Congress has identified that and has put forth some serious questions, and so have the European regulators in that sense.
Well, so which countries are furthest ahead in the development of CBDCs?
Yeah, so ostensibly it's China, but there again, I would put China in its own bucket simply because they, in my opinion, have different design goals, because also in China, you already had payment instruments that were instant and didn't involve cash, like Alipay, WePay, WeChat Pay. And so they have different interests, albeit It will go a long way to facilitate efficiencies and trade within that country, quite obviously. So they are, in that sense, the furthest ahead. Canada has started their development early. I think they are mentally ready, albeit not technically ready. We have observed a couple of technologies that have been initially tested. They are provided by the larger enterprise organizations, and I think for the most part have been tested and put on ice for the time being. And as far as like using open source technologies, we are hopeful that MIT was pledged to work with the Federal Reserve of Boston to put out an open source project on the topic of CBDCs. We'll hopefully make this available sometime next year, which would go a long way for international development, right?
So what are other technology developments that would influence the design of CBDCs?
Yeah, so the largest point is identity here. And I always use that term with quotation marks because there's a whole field of identity technology that actually belongs in the realm of transhumanism. So it's the idea of transferring consciousness to the digital realm. So a lot of people in that space that work on identity solutions. What they're really working on is legal technologies, and they're specifically the topic that legalists refer to as agency. But it's the counterpart that you need for anything like a digital bearer instrument, so a CBDC that functions as a peer-to-peer exchange instrument will need. The point there being is current account-based systems almost always require know your customer regulations and AML regulations. So there you have to provide your government credentials, and if and when those conditions are satisfied, a bank or financial institutions will allow you to create an account. So if this was still true in the future, and if that was still true for CBDCs, then this would defeat a lot of design goals that they and a lot of objectives that they set forth, so specifically onboarding a lot of people that are unbanked today. So there are a lot of movements underway that fly under the banner of what's called self-sovereign identity. And it's a stack that you control. So you as an individual can have access to and then can provide in that fashion that I mentioned earlier, where your credentials become also digital bearer instruments. So that is the most important counterpart, in my opinion, that is missing from the development, and that's not being given enough consideration in those CBDC design papers, because unless we have these functions, it seems very unlikely that a lot of government agencies would go along and allow people to create digital wallets that don't require KYC, right? Unless there might be a scenario where they were limited to certain amounts where you don't have to provide that. But then again, it would defeat a lot of the ideas around the programmability of those instruments, right? Because how do I do KYC on funds that I assigned to a self-driving car, right? That's simply impossible. So the point here being is you have to, at any given point in time, have to have a relationship between asset or a right to an individual. But if that is still tied to legacy technologies that are then tied to enforcement to private entities like banks and so forth, that will hamstring the development of anything that is a digital bearer instrument, including a CBDC, tremendously. So identity solutions are the most important thing.
Well, do you think CBDCs will replace physical cash in the next decade?
Not in the next decades. Very, very unlikely. I mean, cash is very, very convenient, right? And even though some of the design goals in CBDC papers state that these should be transferable without access to the World Wide Web and without access to technology, I haven't seen any practical approaches that would make this actually possible. And I have no idea how this should be facilitated. And so you can think about situations where you are in remote locations, right? You're on vacation on a lake and you need to pay someone to rent a boat, and you don't have access to a tower or something. You can't access your funds on your phone because you don't have connection. Right. So how do you transfer it to them? I mean, yeah, there are some limited options there at the moment, but I think for the next 10 years, we will still see about the same amount of cash usage, maybe even a little more.
Okay. Well, what are the three most important lessons you've learned when analyzing and discussing CBDC proposals?
Yeah, I mean, by now you have heard me mention my pet peeve many times, so
Hmm.
I won't stay away I'll try to stay away a little bit from that. But CBDCs are part of a paradigm shift, right, in financial services. So the one thing that we've observed that it doesn't help if you've been indoctrinated into the legacy financial systems, right? A lot of times we will get pitched as investors on technology and a solution with a team that then references back to some financial services experience. Like I had 10 years of banking with XYZ Bank. So from my point of view, more often than not, that's a drawback. And what I mean by that is, if you think about it this way, your horse jockey might not make the best fighter pilot for your plane, right? And it's a true handicap, it seems, in thinking. The other handicap there is that of specifically legal professionals in that space. And I think that potentially done the most damage to this space. What I mean by that is legal professionals tend to be overcautious and explain the law in a way that doesn't allow technology solutions providers to cater to the needs of the law, but mostly to the needs of the lawyer. What I mean by that is a lot of solutions that are being built right now that are blockchain-based or decentralized software-based actually can more efficiently fulfill the purpose that a law is trying to do, right? So if you think about KYC solutions and preventing money laundering solutions, digital ledgers and decentralized ledgers are an ideal instrument. That's why it's such a common misconception that, for example, Bitcoin transactions are anonymous. They have never been anonymous. They've been pseudonymous and for the most part are easily trackable and not a terrible instrument to do money laundering. It's much easier, and that's the preferred method still to do money laundering with cash. That's why it's often very disingenuous to say, well, we need to outlaw these cryptocurrencies, but at the same point in time, we're exporting 60 some billion dollars, $100 notes internationally, knowing quite well what they're being used for internationally. So that's one of two main misconceptions. Then the other misconception is that CBDC designs, as I mentioned, don't spend much time considering identity solutions. I think there needs to be a tight cooperation with the teams that are developing SSI, sovereign identity solutions, and all of these things to be long-term viable, because anything that doesn't cooperate with these solutions, I don't think will long-term be interesting technology. And then lastly, and that's my largest pet peeve, the remaining function of money is that of language. And money is best understood by its use cases, which is simply spending and vending.
Well, can CBDCs change the position of the US dollar as the world's reserve currency?
A lot would have to go wrong. Right now, the dollar is money of last resort for any other country, to the extent that I believe either 12 or 14 countries eventually gave up on trying to make their own currencies and just permanently peg their currency to the US dollar, right? And that was true for countries like Panama for a very long time. So the only reason why this would happen is if there was another currency that was US dollar denominated and would have all the facilities of being a digital bearer instrument. So would be anonymous, would be, let's call it, swappable against other payment instruments, including US CBDC. In this case, you could see how all of a sudden there would be a lot more demand internationally. But I think that is very, very unlikely, because it comes down to the fact that as a language of value, the US dollar dominates the international landscape.
Great. Well, in the last few minutes that we have here today, what else should we cover that we haven't?
What else should we cover that we have? Well, we've covered quite a bit. Well, I think the largest call to action here would be is understand money as a technology. And I think technology will always move faster than any political discussions, right? As we know. So pay more attention to what is being developed as a technology rather than engaging in some form of political discussion that's mostly useless. I mean, the technology will eventually force political discussion to change. When certain technologies become reality, then government will simply have to react to this. This is why we spend some time talking to government and federal agencies and whatnot, and continue to do so, but we'll still spend most of our time with technologies and helping develop this. And then lastly, I think it's mostly still misunderstood where blockchain-based solutions are today and what blockchain-based solutions are, or what I like to refer to actually as decentralized software solutions. So I think almost no company on the planet that shouldn't look into blockchain-based solutions for their own technology, specifically if you have any databases right now. So if that's of interest, we as I said, like to share our view on this, and we don't have any other agenda there than to share our view for peer review specifically and promote the state of blockchain-based solutions and the development of correct quote-unquote technologies.
So how best for listeners to get back in touch with you?
Yeah, I'm mostly quote-unquote active on LinkedIn, so you can find me there, although I maxed out my connections. So if you want to connect to me, I have to delete one of my old connections. I'm trying to get better to frequently publish things on Forbes. I've been lagging on this lately because I've been sucked into so many discussions around the CBDC topic, which is obviously important. So we're preparing some classes right now for academia to scale this effort so that it's not just us not promoting, but explaining is the right term here. I infrequently tweet, but yeah, then we obviously also have a website. It's just sustany.co.
Well, great. Well, we'll put those in the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Anytime, Paul. Thanks for having me.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.